Alright, so there's something you need to see right now. Not tomorrow, not next week, right now. Because what happened in the second quarter of 2025 just revealed something massive about the direction of money in this world. And if you miss this, you're going to be on the wrong side of a market shift that's already happening. George Soros just made a move. Not the kind of move that makes headlines in the mainstream financial news. Not some dramatic announcement. He literally just adjusted his portfolio, doubled down on NVIDIA, stepped back from Amazon, added significantly to renewable energy. His total fund is now up 18.8% for the quarter, while the S&P 500 is up 9.2. Now listen, I know what you're thinking. Soros moves his portfolio all the time. That's what hedge funds do. And you're right, but here's the thing. This isn't just any investor. This is the guy who saw the British pound was going to collapse in 1992, when everyone else thought it was solid. He made $1 billion in a single day. One day. That's not luck. That's not random. That's a man who sees something the rest of the market doesn't see. And he acts before everyone else catches on. Since then, he's been right 4 more times. Not sometimes, not occasionally. 4 times, 2000, 2008, 2020, and now 2025. So when someone like that moves his money around, there's a reason. There's always a reason. It's not emotion. It's not following the crowd. It's calculation based on seeing patterns that the average person misses completely. Let's break down what actually happened, because the numbers here are pretty extraordinary. NVIDIA position in his portfolio, he took it from around 540,000 shares and basically doubled the stake. We're talking nearly 1 million shares now when you factor in options and positions. This is a guy who's had his money everywhere. Tech, finance, materials, energy, everything. And what he's doing is consolidating into NVIDIA, specifically, not the broad semiconductor sector, NVIDIA, the company that produces the chips that power artificial intelligence, Amazon. His position actually went down slightly. We're looking at a reduction from 97.2 million down to 89.2 million. That's a pullback of about $4 million. Now, 4 million might sound like nothing when you're managing billions, but in the world of hedge fund positioning, that's a signal. You don't just trim a position like that randomly. You trim it because you're changing your view. NextEra Energy, he added 150,000 shares, a company that basically controls about a quarter of all the renewable energy infrastructure in the United States. Solar farms, wind farms, the infrastructure that produces clean power. He's buying into that specifically. Brazil ETF, complete exit. He held Brazil exposure, gone. All of it, divested completely, but he added South Korea instead. Samsung, memory chips, semiconductor manufacturing. He's rotating out of emerging markets that he thinks are going to weaken and rotating into geopolitically safer positions that have semiconductor exposure. Now, here's what most people get wrong about this. They see the numbers and they think, oh, Soros is bullish on NVIDIA and bearish on Amazon. And that's technically what's happening. But that's not actually what's going on underneath. It's much bigger than that. What's actually happening is Soros is making a bet about what powers the future economy. See, everyone right now is staring at cloud computing. Amazon Web Services runs the cloud. Netflix runs on AWS. Your streaming service, your email, everything basically runs on cloud infrastructure somewhere. So the logic is Amazon is going to own the cloud, and therefore Amazon is going to own the future. That makes sense. That logic is reasonable. That's why most investors own Amazon. But Soros is looking at this differently. He's asking a different question. He's not asking who benefits from the cloud. He's asking who produces the equipment that makes the cloud possible. Because there's a difference. There's a real difference. Amazon consumes infrastructure, they build data centers, but they buy the chips from somewhere else. They buy the energy from someone else. They are a consumer of infrastructure. NVIDIA produces the chips. NextEra produces the energy. These are the suppliers. And historically, in every technological transition, the suppliers win bigger than the consumers. Think about the internet boom of the late 90s. Everyone wanted to own the dot-com companies. Yahoo, AOL, all these internet companies, they were going to own the future. But the companies that won were Intel making the chips, Cisco making the routers, the suppliers of the infrastructure. The actual services companies got decimated. Same thing with smartphones. Everyone thought Apple was going to own everything, and they did well. But the real winners were the chip designers and the component manufacturers. The semiconductor companies won bigger. So what Soros is seeing is this: artificial intelligence requires compute. Compute requires chips. Chips are made by NVIDIA. NVIDIA is the only real option for AI chips right now. They have 92% of the market. 92%. That's not a market share position, that's a chokehold. And as AI infrastructure gets built out, NVIDIA is going to be the bottleneck, the one company that everyone needs to go through. But here's where it gets really interesting. NVIDIA chips consume an enormous amount of electricity. A massive amount. A single data center running NVIDIA chips consumes as much power as a small city. We're talking megawatts and megawatts of electricity. And when the data centers are scaling up to run all the AI infrastructure that's coming, the power grid can't handle it, not at current capacity. So you need energy infrastructure upgrades, you need new power plants, you need more solar, more wind, more of whatever clean energy you can get, because that's what's available. And NextEra is the leader in that space. Soros isn't just buying energy infrastructure because it's going to be valuable. He's buying it because NVIDIA chips literally can't scale without it. It's directly connected. You can't have AI infrastructure explosion without energy infrastructure explosion. This is the actual vision. This is what most people don't understand about about Soros' moves. He's not picking individual stocks because they're undervalued. He's identifying the structural bottlenecks in the economy and positioning ahead of where he thinks the money is going to rush. And the reason he's pulling back from Amazon is because Amazon doesn't fit into this picture. Amazon is a consumer of infrastructure, not a producer of it. When the value shifts to the producers, Amazon actually becomes less valuable relative to the producers. It's not that Amazon is going to go to zero or anything like that. It's just that NVIDIA and NextEra are going to grow faster over the next 3 to 5 years. They're going to generate better returns. And when you're managing billions of dollars, a few percentage points of outperformance multiplied across a huge asset base equals enormous amounts of money. Now, the historical context here matters too, because this isn't the first time Soros has made this kind of move. In 1992, he saw that the British pound was overvalued relative to the economic fundamentals. Everyone else saw a currency that seemed stable. He saw the numbers and realized it was going to collapse. He made $10 billion bets against it. The pound collapsed. He made $1 billion in a day. In 2000, he saw that internet companies were valued at infinite multiples relative to their earnings. He saw the dot-com bubble. Most of Wall Street said the internet was the future, we should pay any price. Soros saw unsustainable valuations and stepped back. The bubble popped and everyone who'd been aggressive in tech got destroyed. 2008, he saw the financial system was fundamentally broken. Banks were holding toxic assets and pretending they were solid. Housing market was built on lies. Everyone else was still partying. Soros saw it coming. When the crash hit, he was positioned to buy assets at discount prices. 2020, everyone panicked during the COVID crash. Soros saw opportunity, markets went down and he deployed capital, markets recovered and he made enormous returns. Now it's 2025 and he's making the same kind of repositioning move. He sees that the current market is pricing technology companies in a way that assumes they'll own the future, but he sees that the real ownership of the future is actually in the infrastructure layers underneath, the companies that produce the equipment, not the companies that use the equipment. Most people miss this distinction. They see Soros buying NVIDIA and they think, oh, tech stocks are going up, but it's not about tech stocks in general. It's about identifying which tech companies are actually critical infrastructure versus which ones are value-added services on top of someone else's infrastructure. Amazon is a value-added service. It's incredible, it's huge, but it depends on chips from somewhere and energy from somewhere else. If those inputs get constrained or expensive, Amazon's margins get squeezed. But NVIDIA and NextEra are the inputs themselves. They can't get squeezed in the same way. Actually, they benefit from the squeeze. This is why his portfolio is up 18.8% when the market average is up 9.2%. He's not guessing. He's not throwing darts. He's identifying the structural flow of capital and positioning ahead of it. He's seeing that in the next phase of market evolution, the money is going to flow away from consumer-facing tech services and toward infrastructure providers. So he's already moving his money there. The question for you right now is really straightforward. Are you still positioned like the market is going to reward consumer-facing technology, or are you going to follow where Soros is already moving his money? Because one of those positioning decisions is going to win, and one is going to underperform, and his track record suggests that he usually knows which one is which. Let me show you what this actually looks like in real numbers, because when you dig into the data, it becomes pretty clear why Soros is doing what he's doing. Second quarter 2025, Soros fund was up 18.8%, the S&P 500 was up 9.2%. That's not a small difference, that's 2 times the performance. 2 times. If you had $100,000 invested with Soros fund strategy, you'd be up 18,800. If you had 100,000 in the S&P, you'd be up 9,200. The difference in just 1 quarter is almost $10,000. Scale that to the size of his actual portfolio, and you're talking about hundreds of millions in outperformance. But here's the thing most people don't get. That's not because he got lucky, that's because he positioned differently. He saw where the money was going to flow and he got there first. This is how wealth actually works at the level of institutional investors. It's not about picking the best company. It's about understanding the flow of capital before everyone else does and positioning accordingly. Let's look at what the data says about each position he moved. NVIDIA is producing chips that have basically become the standard for AI training. There's no real alternative right now. You can't train large language models on Intel chips. AMD is trying, but they're years behind. NVIDIA has the architectural advantage, they have the software ecosystem. Every AI company from OpenAI to Anthropic to every startup building AI products is going through NVIDIA. The demand for these chips is not going down, it's going up. We're talking about a $100 billion industry potentially becoming a $1 trillion industry over the next 5 years. NVIDIA is going to capture most of that. Not all of it, but most of it. That's the mathematical reality of their market position. When you look at the utilization data from cloud providers, AWS usage is growing, but it's growing at about 12 to 15% annually. That's good growth, that's solid growth. But NVIDIA's addressable market is growing at 50 to 70% annually because the entire AI infrastructure needs to scale up. The chip supply is the constraint right now. Everything is waiting for more chips. So when Soros doubles down on NVIDIA, he's not making an emotional bet. He's responding to the supply-demand imbalance. There's unlimited demand for these chips, there's limited supply. The company that controls supply in a situation like that captures enormous margins. NextEra Energy is a different story, but it it connects to the same theme. Their renewable energy capacity is getting used increasingly. We're talking about data centers scaling, electric vehicle charging, industrial production, all ramping up. The power grid needs to expand. NextEra is positioned to benefit from all of that expansion. The added dimension here is that the US government is actively trying to build out domestic chip manufacturing. The CHIPS Act, the various state-level incentives, it's all designed to make sure that critical semiconductor manufacturing happens in the United States rather than Taiwan or Korea or anywhere else. That means building data centers in the US. Building fabs in the US. All of that requires enormous amounts of energy. NextEra supplies energy. Simple as that. Plus, NextEra's valuation is reasonable right now. They're trading at about 10 times forward earnings with a dividend yield around 3.5%. Compare that to the overall market, which is trading at 18 to 20 times earnings, and you can see that energy infrastructure stocks are less crowded than general tech stocks. Amazon though. Amazon is in a different position. AWS is great, it's profitable, it's growing, but it's growing at a pace that's not particularly differentiated anymore. The cloud market is maturing. There's competition from Microsoft Azure, from Google Cloud. The margins are compressing as the market gets more competitive. Amazon's core retail business is dealing with massive competition from Asian e-commerce platforms, from direct-to-consumer brands, from changing consumer behavior. The valuation is reasonable, but there's not a compelling reason to be heavily overweight in Amazon relative to everything else. The thing about pulling back from Amazon is it's not a vote of no confidence. It's a rebalancing decision. Soros is saying, I can make better returns putting this capital elsewhere than I can putting it in Amazon. That's all it is. It's not that Amazon is bad, it's that NVIDIA and NextEra are better positioned for the next phase of market movement. Now let's talk about something that's actually pretty interesting from a market perspective. The data on where institutional capital is actually flowing. Not what people say they're doing, not what the financial media is talking about. Where is actual money actually moving? Looking at the quarterly flows from major hedge funds and asset managers, there's been a clear rotation. Money is coming out of consumer discretionary, coming out of traditional retail-focused tech companies, and moving into infrastructure plays, semiconductor equipment manufacturers, energy infrastructure, communications infrastructure, data center REITs. These are the areas seeing the biggest inflows. Soros isn't leading this trend in isolation. He's riding a wave, but he's riding it earlier than most. The difference is you can see the data 3 to 6 months later in the filings. You can see where the money went. Soros sees it and positions before the filings come out. That's the competitive advantage. When you look at employment data in the semiconductor industry, hiring is up 40% year over year. Manufacturing capacity utilization for chip making is above 95%. These are numbers that show extreme tightness in the supply chain. When supply is tight, the producer wins. The producer always wins. Now here's where we get into something that really matters for your portfolio, because what Soros is doing has direct implications for how you should be thinking about your own money. First thing to understand, your portfolio right now is probably not positioned the way Soros is positioned. Most retail investors have heavy positions in the mega cap tech companies. Apple, Microsoft, Google, Amazon, a little bit of NVIDIA maybe. It's a very top-heavy positioning. Is the consensus positioning. When Soros moves away from that consensus, it means he's expecting the market to eventually move away from it too. Not immediately maybe. Markets are slow, consensus is sticky, but eventually the numbers catch up, the valuations adjust, the money rotates. Second thing, when institutional capital starts moving, it moves big. We're not talking about individual investors trading here. We're talking about billions of dollars making directional bets. When billions start moving in a direction, that creates momentum. That momentum pushes prices. Third thing, the data suggests that the companies Soros is moving toward are going to have better earnings growth trajectories over the next 3 to 5 years than the companies he's moving away from. NVIDIA's earnings growth is projected at 40 to 50% annually. Amazon's earnings growth is projected at 15 to 20%. NextEra's earnings growth is projected at 20 to 25% annually. Over a 5-year horizon, that compounds into very different outcomes. Let me put some actual numbers on what this means. Say you had $100,000 to invest and you could choose between positioning like consensus does or positioning like Soros does. Consensus positioning, heavy in Apple, Microsoft, Google, Amazon, call it 50,000 in those 4 companies, 20,000 in traditional energy and materials, 15,000 in bonds, 15,000 in cash. That positioning might generate 5 to 7% annual returns over the next 5 years depending on market conditions. So 100,000 becomes 125 to 140,000 over 5 years. Soros positioning, 40% in NVIDIA and semiconductor infrastructure, 25% in renewable energy, 20% in communications and data infrastructure, 15% in international semiconductors like Samsung. That positioning might generate 12 to 15% annual returns if his thesis plays out. So 100,000 becomes 176 to 201,000 over 5 years. The difference between those two outcomes over 5 years is $50,000 to $75,000. That's not trivial. That's life-changing money for a lot of people. And the difference isn't magic. It's not some special insight that only Soros has. It's just recognizing the flow of capital and positioning accordingly. Now, does this mean Soros is always right? No, he's not perfect. He made mistakes. The quantum fund had down years, but his track record over over decades is substantially better than the average fund manager or the average investor. That's documented. That's a fact. The reason his track record is good is because he thinks about the structural forces driving markets rather than trying to predict daily movements. He doesn't care if the market goes up tomorrow or down tomorrow. He cares about where the capital is going to flow over the next 3 to 5 years based on the underlying economic realities. Then he positions accordingly. The economic reality right now is that artificial intelligence infrastructure is the next major investment cycle. Every major tech company, every major corporation is trying to build out AI capabilities. That requires chips. Chips are NVIDIA. Infrastructure to support chips requires energy. Energy is NextEra. This is not complicated logic. It's just following the flow. The other part of his thesis that's interesting is the geopolitical angle. By rotating out of Brazil and into South Korea, he's making a bet on geopolitical stability and strategic importance. Brazil is facing its own economic challenges and political uncertainty. South Korea is strategically important to both the US and the world because Samsung is a critical link in the semiconductor supply chain. If you're thinking about where geopolitics and economics intersect, South Korea matters more than Brazil right now. This is actually a sophisticated piece of portfolio management. You're not just looking at whether something is cheaper or more expensive. You're looking at the intersection of economic fundamentals, geopolitical positioning, supply chain criticality, and capital flows. That's what separates Soros-level portfolio management from average portfolio management. So now we get to the question that really matters. You've seen the data, you've seen how Soros positioned, you've understood the logic behind it. The question becomes, what do you actually do with this information? Here's what you should understand. You don't have to copy Soros exactly, you don't have to have the exact same positions. What you should do is understand the framework he's using. He's identifying structural imbalances in the economy. He's identifying which sectors are going to benefit from addressing those imbalances. He's positioning accordingly. You can apply the same framework to your own thinking. Where are the structural imbalances in the economy that need to be resolved? What are the constraints? Chip supply is a constraint. Energy supply is a constraint. Semiconductor manufacturing capacity is a constraint. Which companies benefit from those constraints being resolved? The suppliers. The companies producing the equipment. That's the insight. That's what matters. Not the specific stock picks necessarily. The framework for thinking about where value is going to accrue. The reality of markets is that they eventually price in the truth. Right now, the market might be overweighting companies like Amazon because of brand recognition and past success, but eventually the math catches up. The company that's growing earnings at 12% gets valued lower relative to the company that's growing earnings at 50%. That's just how math works. Soros just gets there first. He doesn't wait for everyone else to figure it out. He sees the math and he positions. That's why he makes money. That's why his fund outperforms. It's not magic. It's just paying attention to what actually matters. The investors who are going to do well over the next 3 to 5 years are the ones who figure out that infrastructure is where the value is accruing, not consumer services, not applications running on infrastructure itself, chips, energy, network equipment, communications infrastructure. Those are the sectors where earnings growth is going to be best. Those are the sectors where margins are going to expand. Those are the sectors where the structural economics favor the companies operating in them. Everyone wants to own the glamorous companies. Everyone wants to own the brand name companies. But the money comes from owning the companies that other companies need. That's always where the money is. And right now, the companies that other companies need are in semiconductors and energy infrastructure. This is what Soros' portfolio is reflecting. This is why his fund is up 18.8%. This is why he's outperforming. He's positioned where the value is actually flowing, not where everyone thinks it is, where it actually is. And here's the thing that should make you think. If you're positioned like everyone else and Soros is positioned differently and he's getting better returns, what does that tell you about your own positioning? What does that tell you about whether you're actually looking at market data clearly or whether you're just following the consensus because it's comfortable? That's the real question. That's the uncomfortable question that most people don't want to ask themselves, because asking it means you might have to make changes, you might have to rethink your assumptions, you might have to be uncomfortable, but that's where opportunity usually is, in the uncomfortable places, in the things that most people aren't doing, in the bets that go against consensus but align with the actual math. Soros has made billions because he's willing to position where consensus isn't. His latest moves are showing the same pattern. So what happens next? Well, if his thesis is right, you're going to see continued strength in semiconductors, you're going to see continued demand for energy infrastructure, you're going to see companies like NVIDIA continuing to command premium valuations because their earnings are growing so fast, you're going to see energy companies outperform the broader market because they're benefiting from multiple structural tailwinds. If his thesis is wrong, well then companies like Amazon continue to outperform and the tech sector continues to lead like it always has. But the odds, based on his track record, based on the structural economics, based on where actual capital is flowing, suggest his thesis is right. That's your setup. That's what's happening in the market right now. One of the most successful investors in history just repositioned his portfolio in a very specific direction. He's basically telling you where he thinks capital is going to flow. You can pay attention or you can ignore it. But if you ignore it and you're wrong, well, there's a cost to that. A real dollar cost, a real opportunity cost. The data is there, the framework is clear, the choice is yours.